In this video, we'll talk about what to do and what not to do when there is huge volatility like we have seen in the last few days. So as you might be aware, in the last few days, the Nifty 50 index has been very volatile, primarily due to the uncertainty around the election results. And on Monday, there was a huge gap up and the market rose by around plus 3.25%. The following day, there was a huge drop. The Nifty 50 index fell by almost close to 6%. We can see that as the index was moving towards the close to the 200-day moving average, there was a strong support that buying pressure that came in, and the Nifty closed at around the same levels that we had during Jan 2024. So we have almost the past 5-6 months of gains have been wiped out, and we are at the same levels that we were in Jan 2024. And today also there was some recovery, and we saw close to like plus 3% or something, that there was a huge during the second half of the day. Coming to the main topic of today's video, what not to do. So when there is huge volatility like this, I've been a part of a lot of investment groups, and there are a number of questions around what to do, like whether should you sell your holdings to book profits, or when should you be buying more, or what should you be doing with your losing trades that are currently showing a loss. And there are a lot of chatter around what the investors or the traders should be doing when there is when the market gaps up and falls by a huge percentage the next day. And when there is a huge movements like this, and when we see our notional profits coming down, or when we see some of the trades that are in loss, there is the system one that is takes over, and we are driven to take some kind of decisions, and we have to analyze whether we are taking any rational decisions, or whether we are taking decisions that are mainly based on our emotions. Now, most of us would be driven by this, either the fear of giving up the notional profits, or as you might be aware that we have a strong dislike towards loss aversion. Like the pain of loss hurts us more than the pleasure of a gain. So humans would do anything to avoid such pain in the markets. So this is called as loss aversion. So the most of the questions that come from traders is all driven by these emotions. What we should not be doing is that we should not be taking any decisions that are primarily driven by these emotions, because decisions that are driven by emotions do not contribute to our long-term investment goals, or do not contribute in any way positively to our investment returns. Now, what should you be doing? Now, we should be thinking rationally and acting rationally. For that, we can look at past data. Now, we can look at how did the Nifty 50 perform during the election years. Now, during the past 4 election years, the Nifty during the calendar year has always closed on, has given good returns, like you can see on the screen. But does this mean that every election year the Nifty 50 would be giving us positive returns? No, it is an event in future, and we cannot say for sure or with 100% guarantee that the Nifty 50 would be giving us positive returns. But what I'm trying to show is that when you zoom out and look at the larger picture, what happens in 1 or 2 days around these election results and the exit polls is all noise. So you'll have to have a larger picture, and then view it like what happens over a period of 6 months or 1 year. Because what happens within a day is purely noise, especially if you are a long-term investor, or if you're following a momentum strategy like that I do. I rebalance only on a weekly basis. So on Sundays, I run my scans, and then on Mondays, I place my trades. So what happens between Monday and Friday, all the ups and downs movements is all noise to me. So I will only run my scans on when the market closes on Friday, and then generate the signals for the following week. So if you are someone if you are a swing trader, or if you are a long-term investor, or if you are someone who is following a momentum strategy that is rebalanced on a weekly or a quarterly or a monthly basis, what happens within this 1 or 2 days is nothing but noise to you. Now, you should also be thinking along the lines of whether the fundamentals of these companies. Now suppose if you are a fundamental investor and you are being buying and holding for a long term, like even for a few months or a few years. Now, has the election results or the volatility, or has this changed anything fundamentally in your company? In that case, you can take some decisions, but you will always have to be taking decisions based on your system. You should not be taking any decisions that are driven by your emotions, whether those emotions are either because of fear of giving up those paper profits or notional profits, or whether you are seeing any loss making trades in your portfolio temporarily, and you are psychologically driven to avoid this loss, and you want to act or do something to like reduce this pain. So when you're driven by these emotions, or when you're driven by these psychological reasons, you'll always be making suboptimal decisions that then you might be looking at 6 months down the lane and then regretting, why did I sell my holdings, or why did I book profits during that period. You might be so you should not be taking decisions that will affect your that are primarily driven by your emotions. That's what I'm trying to get. You need to think rationally and act rationally. Now, how can you act rationally? One of the ways to keep emotions out of your trading decisions is to have a systematic approach. Like I had already tweeted during in Indian markets due to the election results, and such volatility can actually shake you out of your investment positions. You might have heard of the book Atomic Habits, and in that James Clear talks about how we do not rise to the level of our goals. We only fall to the level of our systems. Now, what do I mean by a systematic approach? Now, systematic approach means you have rules for everything. So there is no scope for any discretion, or there is no scope for any decisions that are based on your emotions. So rules primarily drive when you will buy, what you will buy, when you will rebalance, when you will stay invested, when you get out of the market. Now, I am a momentum investor, and I have rules around when I will stay in the market and when I will get out of the market. And I also have rules around when I will rebalance, when I will add to my positions. Now, this is an important thing that I want to share with you. Like most of the systematic traders have something called as a regime filter. Now, a regime filter can be something like a 200-day moving average. So they will stay invested, or they will hold on to their momentum positions or their trading positions as long as their index is above the 200-day moving average. And once the index closes below the 200-day moving average, they will start closing their positions, exiting based on their system's exit signals, or then they will not be taking any new entry signals. So this is one of the, like I also had rules around when I will deploy my cash. So based on the past support, I had a rule around, like if the market retraces back to 21,900, I will deploy the additional cash that I have, and I bought around this levels. Now, you will not be able to capture exactly the bottom, but you should be having rules around at what level when the price comes you will be deploying your additional cash. And these kind of rules, everything that you do in the market should be driven by rules, so that you are not driven by your emotions. This is one of the most important things that I wanted to share with you. Hope you found something of value in this video. Let me know in the comments if you found value in this video. Thank you.